Bank earnings season winding down with results from Bank of America and Goldman Sachs. Morgan Stanley rounding things out ahead of the open. That's tomorrow. Goldman Sachs reporting a year-over-year profit decline for the 8th quarter in a row. Meantime, though, Bank of America posting better than expected results, yet the tone from Bank of America CEO Brian Moynihan was certainly less dire than what we heard from JP Morgan's Jaime Dimon. Moynihan saying the economy is slowing but healthy. Joining us now is Ken Leon, CFRA Director of Equity Research. So Ken, let me first just get your big picture take here. You know, they reported, I've got Bank of America right now. They're popping, Ken. Goldman is dropping. What did you make of the results? What did you learn, Ken, from them?
Well, the third quarter for banks was going to be a challenging one, and actually results have been pretty good as you kind of measure out the economy, health of the consumer, commercial loan activity, and even in terms of asset management. So all these areas actually look very stable. There still are other clouds in the picture for the large banks, particularly on tighter bank regulation.
And Ken, on that point, it was interesting to me sort of the tonal difference between, say, a Jaime Dimon and a Brian Moynihan. Even though JP Morgan, I think on the face of it, the numbers looked better, right? But Dimon, of course, in his signature dramatic fashion, talked about regulation, but he also talked about it being a dangerous time right now. Moynihan, on the other hand, talked about a slowing economy, but in general, he said the consumer is healthy. So, like, which of those pictures is more accurate in your view?
Yeah, so you really have to look or read between the lines, and the picture you get, you know, for Bank of America is, you know, Main Street America. You know, the consumer is doing fine. They're just, you know, moving along. For Jaime Dimon, for a bank that has strongly outperformed its peers, it's a matter really of trying to lower expectation of the street, especially bank analysts. So that's always his mission, is to lower the bar, because it's the one bank every quarter that outperforms and delivers across all the lines of business.
And Ken, you did mention regulation. You know, U.S. banks facing these capital hikes. How much of a challenge of that, a headwind, Ken, is that for the industry?
Yeah, it's kind of top of mind, but not anything we're going to get closure this year. There are several proposals. One very technically called Basel III Endgame, which basically means the capital reserves have to be possibly raised anywhere from the high teens to 25% for some of the large banks. And then the regionals, those above $100 billion of assets, are going to be more tightly regulated. So that's a big deal, because then we get into the narrative that these large banks may become more like bank utilities, thereby being more regulated.
And do we buy that? Is that really going to be a big curb on bank growth? It seems to me that the regulation that has been put in place, so even since the financial crisis, the banks have done just fine.
Well, banks are fine, but they've underperformed, and really to get the financial sector and the banks outperforming the S&P 500, first, CFRA's view is that when we move to a rate cut regime of the Fed late in 24, usually 9 months before, financials tend to do well, including banks. Second would be if we have a soft landing and not a severe recession, that means that we're going to have a fairly healthy economy, and we're going to see loan growth for the banks. And ultimately, for the global banks, they are diversified, and we're at the trough of the investment banking cycle. So areas like equity underwriting and also mergers and acquisitions is likely to be better next year.
And Ken, let me ask you about, I want to switch gears a little bit, just talk to you about Goldman's David Solomon. And listen, Ken, you know this company backwards and forwards. I'm just interested, Ken, if you believe he's the right man for the job. There were these just string of press reports, Ken, I'm sure you saw them, that were just brutal. I mean, the New York Times had one, you know, his management style's winning few fans. He's mired in quicksand. He's unsure what to do. I mean, it's really tough stuff. Is David Solomon the right guy for that job, Ken? And do you think his job is secure?
Well, it's funny because I think years and years ago, we were colleagues at Bear Stearns. You know, David Solomon has done remarkable. I think, you know, when you look at the core franchise for Goldman Sachs, plus the support that the board of directors has for David Solomon, I think he's going to do fine. But he just doesn't have that demeanor. He's a nice guy, and he projects that, at least externally. Internally, we don't know. You know, it's kind of strange that in 2023, we even hear Goldman talked about with partners, but they own less than 2% of the stock. So overall, I think he's going to be fine. Goldman's going to have a better trajectory for improvement as we go into next year.
And then one of your top picks is the aforementioned JP Morgan. I guess, you know, like you said, Jamie Dimon's going to Jamie Dimon and sort of say things aren't so great. And then they'll come out and knock it out of the park every quarter. Is that just kind of what we can expect?
Well, they have been doing it. And again, compared to a Citigroup or a Wells Fargo, they have their leadership, their management in place. They really have invested heavily to drive the business versus spend to really correct problems with regulation, as Wells Fargo and also Citigroup have to do.
Ken Leon, CFRA Research Director of Equity Research. Thanks so much, Ken.
Thank you.